Hi, I'm Lance, and today we're going to talk about mutual funds. These aren't some elusive financial instruments reserved for the Wall Street elite. No, mutual funds are actually a popular investment tool that you and I can leverage. But what exactly is a mutual fund? Picture this: a mutual fund is like a basket. Instead of fruits or groceries, this basket contains a variety of stocks, bonds, or other assets. It's managed by financial professionals who make the investment decisions on your behalf. This way, you get to invest in a diverse portfolio without the hassle of managing it yourself. In fact, their popularity stems from this very convenience, along with the potential for attractive returns. But as with any investment, there are risks involved, which we will tackle in this series. Stay tuned as we delve into the world of mutual funds. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors. So, what does this mean exactly? Picture this: a group of people, each with their own financial goals, come together and pool their money. This collective sum is then handed over to a professional money manager who is tasked with the responsibility of investing this money in a variety of financial instruments, like stocks, bonds, and other assets. The goal here is to generate returns and create wealth for the investors. Now you might be wondering, why not invest on your own? Why go through a mutual fund? Well, the answer lies in the expertise and resources that these professional money managers bring to the table. They have the knowledge, the skills, and the tools required to analyze market trends, identify opportunities, and make informed investment decisions. These money managers don't just invest haphazardly. They follow a predetermined strategy that aligns with the objectives of the fund. This strategy could be aimed at achieving growth, income, or a balance of both. The fund's strategy is clearly outlined in its prospectus, a document that every investor should read before investing. The money manager's job doesn't end with just investing the money. They continuously monitor the market, track the performance of the investments, and make necessary adjustments to ensure the fund is on track to achieve its objectives. Now, each investor in the mutual fund owns shares, which represent a portion of the holdings of the fund. As the investments made by the fund earn a return, so does the investor. On the other hand, if the investments incur a loss, the investor shares in this loss too. And here's the best part: mutual funds are inherently diversified. This means they spread their investments across a wide range of assets, which can help to mitigate risk, so you're not putting all your eggs in one basket. In essence, when you buy a mutual fund, you're buying a piece of a large, diversified portfolio. There are various types of mutual funds in the market. Let's dive into the world of mutual funds and explore the different types. The first type, which is quite popular, is equity funds. These funds primarily invest in stocks. They offer high returns but come with a higher risk factor. The performance of equity funds is closely linked to the stock market's performance. So, if you have a high-risk appetite and are looking for long-term capital growth, equity funds might be your cup of tea. Next up, we have fixed income funds. As the name suggests, these funds invest in instruments that provide a fixed return. This includes government bonds, corporate bonds, and other debt instruments. Fixed income funds are a good choice if you're looking for steady income and lower risk. But remember, lower risk often means lower returns. The third type of mutual funds we're discussing today is index funds. These funds aim to replicate the performance of a specific index like the S&P 500. The idea is not to outperform the market, but to match its performance. Index funds are a great option if you believe in the market's long-term growth and prefer a passive investment strategy. Lastly, let's talk about balanced funds, also known as hybrid funds. These funds invest in a mix of equities and fixed income securities, balancing the risk and reward. They aim to provide both growth and income, making them a suitable choice for those looking for moderate risk and return. To wrap up, it's crucial to note that each type of mutual fund has its unique features, benefits, and risks. Your choice should align with your financial goals, risk tolerance, and investment horizon. Knowing the different types of mutual funds helps you to choose the right one for your investment goals. So, take the time to understand these options, and you'll be well on your way to making informed investment decisions. Scene script. Like any investment, mutual funds come with their own set of advantages and disadvantages. Let's start with the advantages. First, mutual funds offer diversification. This is a fancy way of saying you're not putting all your eggs in one basket. By investing in a mutual fund, your money is spread across a wide range of assets, which can help reduce the risk of a significant financial loss. Second, mutual funds provide professional management. This means you have seasoned experts handling your investments, making decisions based on extensive research and market analysis. So you can sit back and relax, knowing your money is in good hands. Third, mutual funds come with high liquidity. In simple terms, you can buy or sell your mutual fund units on any business day. It's like having a money tap that you can turn on or off whenever you need. However, there's no such thing as a free lunch, and mutual funds do come with their drawbacks. First up, fees. Mutual funds are managed by professionals, and these experts don't work for free. You'll have to pay management fees, which can eat into your returns over time. Next, mutual funds offer less control. When you invest in a mutual fund, you're essentially handing over the reins to a fund manager. You have no say in the specific investments within the fund. If you're someone who likes to be in the driver's seat when it comes to your investments, this might not sit well with you. Finally, like all investments, there's the potential for losses. Even though mutual funds spread your risk across various assets, it doesn't completely eliminate it. If the market takes a downturn, your mutual fund value could decline. It's essential to weigh these pros and cons before investing in mutual funds. Understanding these can help you make an informed decision about whether mutual funds are the right investment vehicle for your financial goals. Investing in mutual funds is a process that requires careful planning. Let's break it down into manageable steps to simplify the process. Step 1. Set your financial goals. Are you saving for retirement, a down payment on a home, or perhaps your children's education? Knowing what you're investing for will help you determine your risk tolerance and investment horizon. Step 2. Research different funds. There's a myriad of mutual funds out there, each with its own investment strategy, portfolio composition, and risk-return profile. Some funds focus on stocks, others on bonds, and some blend the two. There are also funds that invest in specific sectors or regions. Take the time to understand what each fund invests in, how it operates, and how it has performed over time. Step 3. Consider the fees. Mutual funds charge a variety of fees, which can eat into your returns. Look for the fund's expense ratio, which is the percentage of your investment that goes towards the fund's operating expenses each year. Lower expense ratios generally mean more of your money is being invested, rather than paying for the fund's overhead. Also, be aware of load fees, which are sales charges applied when you buy or sell shares in the fund. Some funds are no load, meaning they don't charge these fees. Others may charge front-end loads when you buy, or back-end loads when you sell. Step 4. Make the investment. Once you've done your homework, it's time to invest. You can often do this online, through a brokerage account, or directly through the mutual fund company. You'll need to decide how much to invest, and whether you want to make a lump sum investment, or set up regular contributions. Remember, investing in mutual funds isn't a set-it-and-forget-it proposition. It's crucial to monitor your investment, review the fund's performance, and adjust your strategy as necessary. Market conditions change, and so too should your investment strategy. Remember, it's important to keep an eye on your investment and adjust as necessary. So that's a quick overview of mutual funds. We've traveled quite a distance in these past few minutes, haven't we? We've unpacked the concept of mutual funds, delved into their different types, and weighed their pros and cons. Remember, mutual funds are essentially a pool of funds collected from multiple investors, managed by a professional fund manager. They can be broadly categorized into 3 types: equity funds, bond funds, and hybrid funds. Each type comes with its own set of advantages and potential risks. And when it comes to investing, we've learned that it's not a one-size-fits-all scenario. Your investment strategy will depend on your financial goals, risk tolerance, and investment horizon. But rest assured, mutual funds can provide a relatively safer and diversified investment option for many. I'm Lance, and I hope you found this information helpful. Remember, investing is a journey, and mutual funds can be a valuable tool on your path to financial growth.